Bloomberg Audio Studios.
Podcasts, radio, news.
I'm really pleased to say that I'm here with AQR's Cliff Asness. Cliff, thank you so much for joining this morning.
Thanks for having me.
We have to start with your paper that caused quite a bit of a stir. Let me just read the title for our audience. The Less Efficient Market Hypothesis. Quite the claim for someone who studied under arguably the godfather, Eugene Fama, of the EMH. So what did you see that led you to believe this market is less efficient?
Sure. Well, efficient markets in general are this idea that prices, in some rational sense, reflect all information. That's the extreme version of that hypothesis. Gene tells the class, like third week of class, markets are assuredly not perfectly efficient. And you get a gasp because it's the University of Chicago. Everywhere else in the world, they just go, yeah, we know that. But in Gene's class, that's a gasp. So it begs the question, once you accept they're not perfect, how imperfect and does that change through time? And I'm very clear about this in the paper. A lot of this is op-ed. It's my life experience in this business. But over my career, at the very beginning of my career, when we started AQR, 18 of our first 19 months were the blow-off top of the dot-com bubble. And we did a lot of things back then. We were losing a lot of money. That was the bad part. It wasn't statistically like beyond shocking, but it's not pleasant to happen in your first year and a half. And it turned out that the prices between cheap and expensive stocks, in general, using a bunch of valuation measures, maybe they vary between 6 times more expensive to 3 times more expensive, the expensive stocks. They had shot up to like 13, and they'd never been close. It was 50 years of this and then this. So then you spend a lot of time saying, is there some way we're wrong? Is there a reason this is rational? And if you conclude no, you stick with it. Then if someone had said to me at that point, is this going to happen again in your career? I hopefully would never say never. No one in our field, your field, my field, should ever say never about anything financial. But I think I would have said, oh, yeah, probably not, almost definitely not. Because it hadn't happened in 50 years. My career is not going to be another 50 years. I wish it were, but it's not going to be. And the question in your career presupposes you're still here. And you're not the only one. And you guys are probably in charge. So how's this going to happen again? And then even before COVID, it was getting there. But COVID took that same differential and blew it out of the water.
But Cliff, why can't I argue it'll play out the same as last time? That spreads will come back down, value will work again, and it's just we're in another one of these periods.
That's exactly what we do argue. So you are totally permitted to argue that. But the bigger question I'm trying to answer is I see this as a sign of the market getting less efficient about pricing. And in principle, we all think things should get more efficient over time. Technology marches on, data is more available, things that were available at a lag are available instantly now. But I think most of those things go to speed, not to accurate pricing. Yeah, things get in prices faster. But I think there's strong evidence, so not just these two things, but these are the two major ones I experienced, that the crazy periods are getting crazier and lasting longer. So the next question I ask in the paper, and this is very speculative, I admit, is why? Why? And there are probably other great ones, but I focus on 3, and I'll say them really fast.
Sure.
The first is the rise of passive. That's everyone's favorite. Passive has broken the market. I think that is probably part of it. No one knows how many people can actually be passive without breaking the market, but we know it's not 100%. That's a weird world where nobody is thinking about whether NVIDIA is worth more than a candy store.
Yeah.
So the idea that there would be less could weaken the tether to reality?
I want to let you get to the other two,
sure,
because I find them really interesting. But just in terms of that, especially when we're talking about NVIDIA, and this being a crazy period.
You know quants know nothing about individual stocks, right?
Of course, you know nothing about a single stock. I'm very aware of that. How crazy is this period?
We're still, and I won't talk about NVIDIA in particular, but when it comes to the spread between cheap and expensive stocks, we were at a new 100th percentile in COVID. I jokingly call it the 120th percentile, which from my math friends listening to you, there is no such thing. It's just the new 100th. But it was about 20% above the prior 100th. We're back down to about the 80th percentile spread versus history. We still have a little bit of a tilt on, but far smaller than when it was 120. So I would say things are still out of whack, but it's not an arbitrage you can drive a truck through now. But so I think passive is part of it, but it's very hard to know how much. The second one I'll do beyond quick. post-GFC, 10, 15 years of super low interest rates, I don't think justifies these spreads, and we've written a lot about that. But in a very non-technical sense, may that drive investors mad and to do some crazy things? Yes, that's all I'll say about that. My third and favorite hypothesis, because it's so counterintuitive, is I started out saying technology might make things faster but not more accurate. It might, and in fact I would argue probably does, contribute to the less accurate pricing. And in particular, I'm talking about the milieu of instant information, free trading, certainly social media. The dot-com bubble was the first go-around of kind of proto-social media, where you're a little too young for this one, but message boards were very hot. People are all discussing their favorite e-toys and drcoop.coms, and if markets are efficient to some degree, not perfect, the wisdom of crowds, the famous idea that a crowd can be more wise than the average component of the crowd, is a huge part of it.
How much of your Twitter interactions color this? Because you're not afraid to talk to, I just, when you're talking to people who you don't agree with online, does some of that color it saying, maybe this crowd isn't so wise?
I hope not. May it sneak in? I would have to admit it might sneak in. But if a wise crowd is the goal in a market, have we ever had a vehicle better than social media for turning a wise crowd into a dangerous mob? And I'm not going to get political, I'm not going to choose a political side. But if our politics are not a great example of this, I mean, there was a point 20 years ago where we had utopian views with that social media would make us all like each other more. I don't think I need to convince any of your viewers that that has not happened. And I think a lot of the same has creeped into markets. It's unfair to choose the most crazy example, but a poster child, not a proof, are the U.S. meme stocks. They are the most extreme example of what I'm talking about.
Right.
Crazy valuations driven by social media. But life is not just them and everyone else. It's a point on a spectrum. So I do think markets have gotten somewhat less efficient.
Right.
I think the final interesting question is, what does that mean for a rational style of investing?
Can I ask, because you also point out in your paper that it's a problem for society.
Yeah.
Why is it a problem for society?
Well, if you're actually going to read the paper, it's going to make this all take longer. You know that, right? It's a problem for society, and I think I'll be a cheerleader for our industry.
Yeah,
I don't think
got to be quick here, Cliff. Only 30 seconds.
I don't know if enough people think about it this way, but rational prices are very important to a free enterprise society.
Yeah.
When prices are wildly irrational, prices are how we allocate resources.
Yeah.
And we do it in a very unproductive way if companies that are not very productive and are speculative and pie in the sky are getting all the money.
Yeah.
So it matters. And let me finish with one thought. What does it mean? Well, if markets are somewhat, I don't say they're terrible, less efficient, deviations from fair value
Cliff,
will be...
We got to end it there. I'm so sorry. We're
deviations from fair value will be bigger, last longer, but you'll make more money from them.
Cliff, you nailed it. Thanks so much. That was Cliff Asness of AQR over here at the Kepler Conference.